You should be looking at how is this policy, utilizing the policy, going to make me more money? And that's just my personal opinion. Again, you can use it technically for anything, but I wouldn't recommend it using it if it's not going to make you or save you money in one way or another. So very important. Next is what I want to talk about is just going about an example here. So if let's say you need a $50,000 x-ray machine, what is this actually going to look like? So if you need a $50,000 x-ray machine, keep in mind, you need to have enough money in your cash value. So if you want a $50,000 x-ray machine, you have to have, well, you're gonna have to have more than $50,000. Typically, you're able to borrow up to 95% of your cash value. So for easy math, if you have $100,000 in your cash value, you'd be able to borrow up to about $95,000 of that. So if you need a $50,000 x-ray machine, you have $100,000 in your cash value, this is what the process would look like. So instead of going to a bank, right, like you normally would, or some third-party lender to get a $50,000 loan, and then obviously you now can get the x-ray machine, and then you'd have to make payments back to the bank or whoever the lender is. By utilizing a whole life insurance policy, this is what you'd be able to do. So you've got $100,000 in your cash value. What you would do is you would go to the insurance carrier that you're with. Very easy, you can call them up. Some carriers have online portals where you can put in a request. But basically, you would request a $50,000 loan against the $100,000 that you have in your cash value. So what I'm about to share here, this is where when I first learned it, kind of blew my mind, is when you get this $50,000 loan from the carrier, what's going to happen is your full $100,000 that you have in your cash value, that's going to stay fully intact, meaning that full $100,000 is going to continue to earn interest and dividend on it as if you never touched the money in the first place. So that's the power of utilizing these policies for financing, is your original bucket of money, if you want to look at it like that, is going to continue to grow and earn interest in the background. Meanwhile, you have a loan against it for, in this case, $50,000. You can use that $50,000 now to go purchase the x-ray machine in cash, and then you can make repayments back to your policy completely on your own terms. So the pause there, I know that was a lot. I need to circle back or touch on something else. So when you're requesting or calling up the insurance carrier for this loan, keep in mind, there's not going to be a credit check. Unlike, traditional financing, there's going to be no credit check because it's life insurance. The money that you have in the policy is yours, and there's contractual provisions in the policy that give you it's a loan provision. So you have a contractual right to request these loans, and the life insurance carrier you're with cannot decline it for any reason. So that's a very powerful leverage point that you have. So there's no credit checks. And then arguably the most important thing to all of this is there's no repayment schedule on the loan. So when you go, if you're financing an x-ray machine through the bank, for example, you're going to have to abide by their repayment schedule, their terms. Now with a loan from the life insurance carrier, you can decide how and when you want to go about repaying that. Now keep in mind, there is going to be an interest rate for the loan from the life insurance carrier, but you have to keep in mind, you're going to be earning interest and dividends inside of your policy still. So in some scenarios, like in this scenario, you might actually come out ahead to where your policy is earning more than the loan cost. So that's a topic for another video, but just know there is interest on the loan, but the way you should look at it is the interest that you're paying on the policy loan, that's your control cost. So if you have a 5% interest rate, which is pretty common across the board, 5-6%, somewhere in that range, depending on the carrier. If you have a 5% interest rate on this $50,000 loan, look at it as I am paying 5% interest to fully control this $50,000 or this bucket of money. Because again, what does control mean? It means you can decide how and when you want to repay back the money, which is critical. So if you're, and here's a scenario to think of for all of you dentists, is if you're financing an x-ray machine through a bank, right, and you have to abide by their terms, and let's say something happened in your business or your practice where you're having cash flow problems and you're having a really hard time with coming up for the money to pay back the x-ray machine. Well, with financing it through your policy is, remember, you're using the insurance carrier's money and then you go and purchase that x-ray machine in cash. So you own it free and clear. Now the thing is, you have to make repayments back to your policy, but remember, you have control over how you do that. So if you needed to pause repayments, for example, let's say a good example is during COVID when everything shut down. Like if COVID really affected your business and you financed that x-ray machine through your policy, you could have completely halted repayments to that x-ray machine, or rather back to your policy, for 2 years if you needed to restabilize and do what you needed to do to gain more cash flow. You could have totally done that, no problem, and then year 3 or 3 years later, you could have started back up on making repayments on that loan that you had for the x-ray machine. So that is the power of utilizing whole life insurance to do or to finance the things that you would normally be financing in your life, because it gives you control. And I'm going to keep emphasizing that, is the control aspect. It gives you control, and you're not losing opportunity cost on your original dollars.